Strategic equity was founded in 1992 by an engineer named Rick Gage. One of the reasons our firm has survived for nearly 25 years is our core value of continuous improvement. We are not stubborn. We're not so arrogant to believe we found a bulletproof model. And as people have seen who followed our firm over these years, we're willing to admit we do not always get it right, and there are always ways we can get better. When I joined Strategic Equity 18 years ago, I had a background in traditional portfolio allocation. After suffering through the mini Asian contagion of 1997, where the NASDAQ lost 20% in just a couple of weeks, I began seeking ways to lower the volatility in my portfolios. When I stumbled upon Strategic Equity in the fall of 1998, I was really ready to listen to a new way, at least to me, of managing money. Since joining SEM, Rick, Steve Goad, and I have tried to combine my background in finance with their background in engineering to create portfolios designed to handle all kinds of markets. One of the key tenets of our portfolios has always been to prevent clients from making emotional decisions due to market volatility and losses. While over the longer term we fully believe our tactical models are going to lead to a better client experience, we're going through a period of time where clients are becoming emotional with their decisions, not because of losses in their portfolios, but rather out of fear of missing out, or as I've heard it called, FOMO. As some behavioral finance have also described that feeling where people just feel like they have to get into the market. This is the third time in my 18-year career I've seen normally rational clients and advisors let FOMO dictate their decision making. Now, I plan on being around SEM for at least another 30 years, and I really don't want to go through this experience 5 more times. It's so disheartening to see a client that originally told us they were risk averse suddenly bailing on a suitable strategy to chase higher returns. Really, the goal of our new portfolios, and one I firmly believe will help significantly during the next market cycle, as well as the rest of this cycle, is to remove dependence on bear markets from our business, and thus all of our advisors' businesses as well. In addition, for those advisors that have always followed a more passive investment strategy, especially with this new Department of Labor ruling and the focus on commissions versus fees, as well as the value added to the portfolios, we wanted something that would remove the dependence on bull markets from their book of business. So first, a little background. Wall Street really likes to throw around a lot of jargon when it comes to describing investments. We have to keep in mind most of the terms we use today were not around 10 or 15 years ago. For example, strategic portfolio management is a rather new term that really describes the exact opposite of what strategic equity management is all about. Back in 1992, strategic equity management was a perfect description of what we did given our mathematical, unemotional, and rules-based approach to investing. Unfortunately, we now see strategic management to mean something completely different. Strategic management, or sometimes called strategic portfolios, is a term synonymous with passive, buy and hold, or index strategies. The asset allocation is selected based on the client's return objective and risk tolerance, and then is adjusted based on the calendar. Really, if you want a good example of that, think some of these target date funds or any of the Morningstar portfolios or other asset allocation type portfolios you'll see with the description preservation, conservative, moderate, balanced, growth, aggressive growth, whatever it might be. There really isn't anything strategic about this style of management. The next term, active management, is something the mutual fund industry has hijacked. And really, in our industry, the term active means anything other than passive or strategic. Down the road from active, though, is dynamic allocation, and this becomes important to understand as we walk through our new dynamic portfolios. A dynamic allocation is an active offshoot of the strategic allocation, where the manager over or underweights portions of the strategic allocation based on current market or economic points of view. It still remains heavily invested in the overall benchmark throughout the market cycle. The final term is tactical management. Now, this is a highly active strategy that will completely avoid portions of the benchmark based on market factors for a prolonged period of time. Tactical management is what SEM has been doing since 1992, and this remains the core of our product offerings. Now let's talk a little bit of how these programs have come about. These programs have really been running around in the back of my mind since before I joined SEM in the late 1990s. Over the years, I've struggled to find a way to pull my traditional portfolio management knowledge into a portfolio that can work well across the full market cycle. As our longtime advisors know, I enjoy studying and forecasting the economy. I first began building my own economic models in 1995, utilizing books from the library. When the Federal Reserve Economic Database first came online, oh my gosh, was I in heaven. I remember just hopping online and 10-keying all the data into my spreadsheets that I could find. This was before you could get the file in a easy to use format, and then thankfully they evolved into having a text-based download that I could get and dump into my spreadsheets. And by the way, if you really are into the economic data like I am, they now have a spreadsheet add-in. So once you know the code, I believe there's tens of thousands, if not hundreds of thousands of codes in there. So if you know the code of the series you're trying to get, you put it into your spreadsheet, you hit update data, and voila, there it is. So every time there's an economic release, all I have to do now is hit that. Now I remember being on vacation and having my little handheld computer and having to type it in just to keep my economic models up to date. So it's really evolved over the years, and thankfully so. And what it's also allowed us to do is, since 2003, I've been reporting on my leading economic indicators. Now, I'll throw my opinions in there, but the key thing to understand is my model is based on what the data says. No more, no less. So our dynamic portfolios can be considered a top-down, economic-based approach. But the struggle I've always had is, how can I take my economic outlook and apply it to the asset allocation decision? Looking at the economic indicators I follow is an easy place to understand that the economy really can be in three strong states. You have strong growth, slowing growth, or sometimes called a recession, and then you have somewhere in between. So depending on the look-back period, 90 to 95% of the average stock's performance is dictated by the industry they are in and the overall direction of the stock market. I learned this the hard way back when I was picking individual stocks, and I've watched it happen over and over again in the last 18 years. For instance, I remember I had position in Nortel in early 2000, and great industry, at the time a really great company. But then Lucent came out and they announced that they had been making up their earnings and cooking the books a little bit, and every single company in the telecommunications equipment sector got clobbered. And then it turns out, we found out 2 years later, Nortel was also cooking the books. And as not to get too far off track, but that's something that is one of the dangerous things about owning individual stocks. So keep in mind, 90 to 95% of the growth or the direction in a stock is dictated by the sector that it is in, as well as the overall direction of the stock market. So it becomes very difficult to add an advantage by picking out individual stocks. If a company that might be the best in the industry, but if we go into a recession or their industry runs into hard times, they'll still lose money. The real thing that I kind of struggled with, how to apply this economic model to the asset allocation decision, was trying to figure out which sector to be in. And I was really getting too cute. I knew what the textbooks said about industry sector performance at various stages. You want to be in consumer staples during a recession, and you want to migrate into technology during that. And so I was really trying to get really down to the micro performance. But as I studied it over the years, I really couldn't find a solid model that could get this right on a consistent enough basis to trust client assets in there. Really, I was trying to be too perfect with the allocation decision, and I ended up with just a big jumbled mess. something Steve Goad, who has a PhD in electrical engineering, and he used to make his living designing those power supplies for all of our electronics, always told us was the more complex a system was, the more chances of failure you have. And that applies to a machine, it applies to your computer, and it also can apply to trading systems and investment programs. So I started to focus on just a few key sectors, down to 5 from the original 14, and things started to look a little more clear, but I wasn't quite there yet. As I was studying for the CFA, and it was actually in the spring of 2015, it really came into view for me. It all came together. Modern portfolio theorists out there have drilled into our heads the advantage of being in a small cap and emerging market stock. They've told us over and over again, you got to be in small caps, you got to be in emerging markets. We've seen mutual funds out there that are really in existence because of this so-called advantage. So these portfolios are all overweight those assets because the long-term results say that's where you can increase returns and lower your risk. But there was a passage in the CFA Level 2 materials warning about how you utilize the data and a so-called advantage. And the passage that just jumped out at me that really pulled these together was when you exclude a 6-year period in the late 1970s and early 1980s, the small cap advantage completely goes away, and portfolios, including small caps, actually underperformed large cap only portfolios. That's really when the light bulb went off for me, and how I decided we could switch and differentiate ourselves from a strategic or a passive, more buy and hold portfolio like the DFAs and Morningstars and Vanguards and everybody else has, and become a much more dynamic portfolio. So I just tried to input a very simple idea. You want to overweight small caps in emerging markets during periods of strong growth and get out of them during slow growth or recessions. Really, it's quite simple, and the economic logic is solid, because small caps in emerging markets will thrive when the economy is doing well, and they suffer when it isn't. So why are we getting ready to launch these portfolios now? Really, if you look at valuation levels, you've read my blogs over the last couple of years, and you understand the valuation levels we're at places where we've only seen them during past market bubbles. And this is getting to be close to the longest running bull market in terms of time in the history of our country. I was actually ready to go with these portfolios last spring after I finished CFA Level 2. And I knew, just based on my experience, that we would start to see too many people moving out of our lower risk programs and into this new program if we were not careful. So I said, and this was our plan all along, was we'll wait until during the next bear market to launch this. In the spring of this year, I read a research report from Ned Davis that broke bear markets into 2 types: a recessionary bear market and an economic expansion bear market. Now, that really drew me to this research because we've always said, hey, a stock market loses 40% just before and during a recession. That's the bear market that everybody thinks of. But the conclusion was clear in this Ned Davis report. The bear markets we are all afraid of, those long, painful 40% drops, had that key thing that I just mentioned. It's during a recession, just before and during a recession. The other bear markets tended to be shorter in duration and are more of a sideways consolidation of a general uptrend during an economic expansion. So if you look at the market from the end of 2014 through February of this year, we really can make a case that we had the bear market we had all been waiting for. It was a stealth bear market. It didn't quite reach that 20% level that most of us use to identify a bear market, but it got close, 14.5%, and then it had another 11% drop in there. And the duration of that actually matches up what you would see as far as a bear market during an economic expansion. And then looking at my leading economic indicator models, we're not going into a recession. That's one thing that I think our longtime listeners have really thanked me for is I haven't jumped into this, oh, look out, sky is falling, we're going into recession. The U.S. so far is fine. And using an asterisk, as long as the Fed doesn't screw things up, my models do not show that we're heading towards a recession in the next 18 to 36 months. We're still tracking along in that right now, as the model says, that so-so growth, but it's not a recession. And that becomes important because we want to give our clients a portfolio that they can still participate in the next 18 to 36 month bull market, just in case. Otherwise, if we don't have this in our lineup, we run the risk of seeing what happened during 1999 and 2000, and again in 2006 and 2007, which is clients that belong in a risk managed portfolio end up leaving risk management altogether. And as you'll see as we go throughout this seminar, we're going to not recommend that you wholesale make a change to these dynamic programs, but you place them in there so that clients have something to point to with, if we keep going up for another 18 to 36 months, but they also still have some defensive options if we do hit that recession or start heading into a recession, which again, I think as we look right now, the only thing that's going to really cause that is the Fed. I'll throw in another asterisk, or what the next president decides to do. So understanding this background, let's dive in a little bit of how these portfolios are structured and where they might fit in an investor's overall portfolio. So let's take a little bit of a step back and look at traditional allocation, or what is now referred to as a strategic asset allocation. This chart here really shows how somebody comes up with a strategic allocation. It's not that hard. Essentially, a portfolio manager would look at all the available assets, they'd look at the return and the risk history of all of them, and put together a portfolio of assets to meet all the various investor types and their perceived risk tolerance levels. And we've all seen these. You have a preservation, conservative, balanced, capital growth, aggressive. That's what you end up with. You can throw out all sorts of other terminology in there, but they essentially end up on this sliding scale from low risk up to high risk portfolios. They all end up including mostly the same asset classes. I've looked at dozens and probably hundreds of different asset allocation or strategic portfolios, and they all end up about the same. It's just a matter of how much weight they have in each of the asset classes listed there on the left. They assume that all the long-term correlations that they used when they developed their models would remain in place, meaning the level of diversification helps them reduce risks in the portfolios, and most importantly, it assumes the investors would remain rational at all times. Now, as we've seen in the past, the correlation among asset classes tends to spike during periods of market shocks, whether it's a mini market shock like we saw in, say, August 2015, or the summer of 2011, or those big market shocks like 2008 and 2001 to 2002. Most of the time during those market shocks, all portfolios tend to become correlated, which causes, all asset classes become correlated, which then the portfolios tend to lose a lot more money than they were designed to. This then causes those investors who were supposed to be rational to think emotionally. They thought they were in lower risk portfolios because the correlations all spiked during the market shock. They lose more money than they thought they could or thought they were comfortable with, and then they end up acting irrationally. Now let's look at SEM's solution to some of these problems. SEM fully understands and believes in diversification as a way to reduce risk in a portfolio. We implement this in each of our investment programs. We spread out the indicators, time horizon for the evaluation period, and the asset classes inside of each of our programs. In addition, we've designed our programs to focus on a wide range of return and risk profiles, and we've reduced trading system overlap between our systems as much as possible. So when we look at asset classes as far as SEM's lineup, we do the same thing as those other asset classes. We want to have low risk all the way down to high risk. But what's really important to understand and makes us different than most other tactical managers out there is there's no overlap between income allocator or tactical bond and what we're doing inside of enhanced growth. In addition, we have no overlap in trading systems between enhanced growth and dynamic aggressive growth, which means if one system is not working in the current environment, it will not bring down every program. And we've seen times where, say, tactical bond and income allocator are going into the market and taking on risk at the same time enhanced growth is reducing risk, and vice versa. Other times, like now, they're all basically fully invested. They're in a risk-on type mode, but it's going to be different over the years. We're not going to be trading the same thing all the way down the spectrum. Now, while each program can be used to fill a specific role in a client's investment portfolio, the real advantage of SEM's active management comes from our Encore portfolios. These portfolios are created using our own optimization process and combine our various programs into a portfolio that is designed to meet a wide range of investor types. Now, we're going to take a look at how this works in a minute during our next presentation. So let's take a break.